Hey guys, welcome to the Bitcoin Fortress podcast, helping you increase your financial freedom. This is episode 36, recorded here on October 16th, 2022. This podcast is for entertainment only and is non-investing advice, so please do your own homework. All right, well, lots to go over this week. I guess we'll start up with a market update. Stocks went on a roller coaster ride with the major averages seeing a historical but epic turnaround. A hotter than expected rise in core CPI inflation had all the hallmarks of a huge sell off, but the broader market bounced back. More than 5 percentage points on an intraday level. Shares surged and bulls looked to be back in control, but then inflation reared its head again in the last trading day, and the University of Michigan's survey showed inflation expectations 1 year out rising for the first time since March. When the dust settled, the S&P closed down 1.6%, and earnings are now likely to drive market direction going forward. Looking ahead to the coming week, the first busy week of the earnings season will feature big reports across sectors with Bank of America, Johnson & Johnson, Netflix, and Procter & Gamble all due to step into the earnings confessional. Meanwhile, the economic calendar will include updates on industrial production and the closely watched Empire Manufacturing Index. On the global stage, the Communist Party Congress begins in Beijing with President Xi expected to secure a historic third term. Inflation readouts and reactions are also likely to be a major factor, and historians will be quick to circle October 19th as a day for hard hats. Okay, moving into Bitcoin news here. First one we have is this is from Bitcoin.com. This was published today. U.S. lawmaker calls on SEC to issue crypto regulations, says a formal regulatory process is needed now. U.S. Senator John Hickenlooper, who's a Democrat from Colorado, has sent a letter to the chairman of the Securities and Exchange Commission, Gary Gensler, regarding crypto regulations. In his letter dated October 13th, the senator told Gensler, "Clear rules promote an environment where investors are protected," adding, "I write to urge the SEC to issue regulations for digital asset securities through a transparent notice and comment regulatory process." He stressed, "Currently, digital asset markets do not have a coordinated regulatory framework. This creates uneven enforcement and deprives investors of a clear understanding of how they are protected from fraud, manipulation, and abuse." Noting that existing laws and regulations were not designed for digital assets, he explained, applying the old rules to the new market could inadvertently cause financial services to be more expensive, less accessible, and the SEC's disclosure regime to be less useful to the American people. The senator noted, "Given the complexity of these issues and recognizing that some digital assets are securities, others may be commodities, and others may be subject to a completely different regulatory regime, a formal regulatory process is needed now." Although all I've heard is they're either securities or they're commodities. I don't know what the third would be, but that's interesting. But anyway, this will significantly improve policy development and allow the SEC to collect views and understand concerns, he said. The senator proceeded to outline some of the key areas that the SEC should address, including clarifying what types of digital assets are securities. Well, that's easy. They're all securities except for Bitcoin and maybe Ethereum. I don't know. Addressing how to issue and list digital securities, establishing a registration regime for digital asset security trading platforms, and setting rules on how trading and custody of digital assets should be carried out. Hickenlooper opined, "I recognize these questions are complicated, but it is time for the SEC to engage." So again, that's interesting, but we've already heard Bitcoin as a commodity. Commodities are regulated by the Commodities Future Trading Commission, not the SEC. And there really hasn't been any ruling on all the other crypto assets from Ethereum on down as to whether or not they're commodities or securities, but I think the prevailing thought is that they're securities, and so we shall see. Uh, Next, this is also from Bitcoin.com. This was posted 2 days ago. JP Morgan reportedly terminates relationship with Kanye West. Rap star says he's happy to speak openly about being, quote, canceled by a bank. And by the way, I'm not necessarily a fan of Kanye, but I just think that it's kind of interesting how censorship has made its way into our financial system. I think last week we talked about the potential fine for misinformation that PayPal was considering until there was a lot of backlash, and then they said, oops. So, moving on with the article here, the American rapper, songwriter, and record producer Ye, Kanye West, has been dealing with a lot of flack lately, while one of West's tweets says, "Who you think created cancel culture?" On October 9th, more recent tweets have been removed from the celebrity's Twitter profile. Furthermore, Ye has been controversial for recently wearing a White Lives Matter t-shirt. In a tweet shared on October 7th, Ye shared an image of a hat that says 2024, possibly hinting at another attempt to run for president of the United States. Following all the controversy surrounding the Atlanta-born musician, the political commentator Candace Owens published a tweet that shares an alleged letter Ye received from the financial giant JP Morgan. Earlier today, I learned that Kanye West was officially kicked out of JP Morgan Chase Bank, Owens tweeted. On Wednesday, I was told there was no official reason given, but they sent this letter as well to confirm that he has until late November to find another place for the Yeezy empire to bank. Owens added, "We have reached extremely frightening times in this country. Who are who or what has landed us into these times is an ongoing discussion which I would like to open up." Following the tweet from Owens, New York Times DealBook confirmed JP Morgan has closed the account of the rapper. Ye also shared comments about the situation with Page Six, and he noted that he was happy that he crossed the line. "Hey, if you call somebody out for bad business, that means you're being anti-Semitic," the rapper noted. "I feel happy to have crossed the line of that idea so we can speak openly about things like getting canceled by a bank." Ye's story follows the recent report about PayPal's terms of service when the company sent out a terms of service change in error. A copy of PayPal's terms of service had shown the company would fine users $2,500 for the spreading of what the firm called misinformation. However, PayPal retracted the user policy information after the social media backlash and said it was published in error. The payments company said an AUP notice recently went out in error that included incorrect information. Delete PayPal searches on the internet jumped 1,400% following the PayPal TOS mix-up. Meanwhile, crypto supporters on the Reddit forum r/Bitcoin said that Ye should move toward censorship-resistant money like Bitcoin. One Redditor wrote, "I'm not into pop culture or celebrities, but this situation represents a colossal opportunity. It will bring so much attention to Bitcoin if this guy came out in response to JP Morgan on social media and said, 'F the banks then, I'll move over to Bitcoin.'" Uh, so anyway, again, no matter what you may think about Kanye West, the fact that the bank basically just said, "We don't want your business anymore," um, is, and it was clearly had nothing to do with his business. It was all about his personal views or actions or whatever, um, is very interesting and certainly, you know, a troubling trend. And of course, with Bitcoin, nobody can take away your Bitcoin. So you don't really have a centralized, um, there's no centralized function. So, nobody can say, take it away or say you can't use Bitcoin or anything like that. So some people have a hard time with that because that means friends and enemies alike are using the same currency. But um, that's kind of what goes with the territory of being free. So moving on here, This is just kind of a recap of several articles from Cointelegraph. This was published on October 15th. So the first top story here, breaking: Google taps Coinbase to bring crypto payments to cloud services. So starting in early 2023, Coinbase's payment service, Coinbase Commerce, will facilitate crypto payments for customers purchasing Google's cloud services thanks to a deal between the two companies. Google will only allow certain crypto assets for payment, including Bitcoin, initially limited to certain participants. The option to pay with crypto will eventually be expanded to other customers. An executive at Google Cloud told CNBC Google Cloud has taken several other steps toward crypto and blockchain industry involvement in 2022. Next is BNY Mellon, America's oldest bank, launches crypto services. Banking giant BNY Mellon has entered the crypto custody field, offering certain customers Bitcoin and Ether custody services via their new platform. The 238-year-old bank will provide bookkeeping for clients' crypto in a similar fashion as it does for traditional assets, while also handling clients' private keys. BNY Mellon CEO of Securities Services and Digital, Roman Riegelman, said, "With digital asset custody, we continue our journey of trust and innovation into the evolving digital asset space while embracing leading technology and collaborating with fintechs." Next here, SEC rejects WisdomTree's application for a spot Bitcoin ETF again. Following multiple delays, the United States Securities Exchange Commission has denied WisdomTree's spot Bitcoin exchange-traded fund proposal, which the firm filed in January. The SEC cited fears of market manipulation and fraud as the rationale for its decision, which is consistent with its previous rationale for denying spot Bitcoin ETFs. The SEC also denied a spot Bitcoin ETF proposal from WisdomTree in 2021. Again, very interesting, since other countries have already approved these and have been using these for a while. Canada has several, and I'm not sure about other countries, but I do know there's a couple in Canada. Someday, maybe. PayPal says policy to punish users for misinformation was in error. PayPal's acceptable use policy was set to change in early November to include a $2,500 fine for any platform users that promote, post, send, or publicize so-called misinformation. PayPal has since claimed that the policy provision was added in error. PayPal is not fining people for misinformation, and this language was never intended to be inserted in our policy, said PayPal. The fiasco has reignited concerns about centralized platforms among crypto users who view self-custody as an important pillar of self-sovereignty and financial inclusion, and I would agree with that. And also, these types of changes to policies don't actually make their way through without thorough corporate and legal review. So the fact that they said it's a mistake is probably a lie. And so anyway, centralized platforms are use those at your own risk, especially with Bitcoin. I would always recommend holding your own keys. Blockchain games and metaverse projects raised $1.3 billion in Q3. Data from DApp Radar revealed that $1.3 billion worth of venture capital flowed into metaverse projects and blockchain games in Q3, a bright spot amid crypto bear market darkness. While venture capital funding for these sectors was down 48% compared with Q2, the Q3 figure was still more than double the amount invested in all of 2021. Very interesting. Okay, moving on. Next article is actually an opinion piece I thought was kind of interesting from CoinDesk. This was authored by Noel Atchison. It was published on October 14th. Bitcoin is macro but not correlated in the way you think. We tend to use the two terms macro and correlation without understanding what they mean. Bitcoin is correlated. I often hear that thrown out in conversations as a dismissive way of saying that it isn't really an alternative asset at all, and that all this mumbo jumbo about it being external to the broader economy is just hopium. But very few who say this actually have dug into the data or thought about the reasoning behind that claim, which is understandable. Why mess with convenient narratives? I confess that even I used to think that a surge in the correlation between Bitcoin and the S&P 500 was because the institutional investors marched into the market in the second half of last year. Now I'm not so sure. The institutions did indeed march in, and Bitcoin has to a large extent become a macro asset, but I don't think that's driving the correlation data. Before we start looking at charts that tell a different story, let's have a think about what correlation actually means and why we care. In theory, correlation is simply the measure of the degree to which the movements of two series are related. It measures how much two measures vary together divided by how much they usually vary individually. There are other types of correlation with different formulas, but that's too nerdy to get into here. For those who care, I use Pearson on a rolling 60-day window. Imagine two assets that are clones of one another, of each other. How much they move independently will be exactly the same as how much they move together, so the ratio between the two factors will be 1. A correlation of -1 means they move perfectly in the opposite direction. A correlation of 0 means there is no obvious relationship between the two. In reality, these perfect situations never exist. Correlations are generally a messy amalgam of erratic behavior that indicates strong or weak relationships used by investors to design relatively robust portfolio strategies and by analysts and storytellers to spot changes in trends. Yet, one trap many fall into is to treat correlation as a binary condition. To say something is correlated is vague and inaccurate. Highly correlated, negatively correlated, those qualifications make sense. Yet even then, only at a specific point in time, as we will see when it comes to market relationships, especially concerning an asset as young as Bitcoin, things change fast. Another frequent trap is to assume that a high or low correlation can explain behavior. To some extent, this is true, but more often than not, the relationship is coincidental, even if related. Ice cream sales and cases of sunburn are highly correlated, but one does not cause or explain the other. Back to Bitcoin, as you can see below, and there's a chart. I'll include a link in the show notes for this article, like I normally do for all the articles actually that I'm going over. The asset used to be pretty much uncorrelated to the S&P 500, oscillating around 0, even as institutions marched in, pushing the Bitcoin price to an all-time high in November. But something changed in April of 2022. What changed? The overall market mood. Correlation is more about the direction than the size of the price moves, although both matter. The below chart shows that up until the time that the 60-day Bitcoin S&P 500 correlation had crossed 0 on the way up, never to return, question mark, the two series had sort of been moving in sync, but not really. By April 4th, the S&P 500 was down 0.7% on the year, while Bitcoin was down 7.5%. And the 60 days prior, the snapshot window for the correlation calculation on any given day showed different trends for each. What triggered the mood change? Interest rate expectations. Fed funds above 2.5% started to become a remote possibility in terms of market pricing in early April 2022, when the actual range was 0.25 to 0.5. This freaked the market out, and the macro investors who piled into the crypto market over the previous 9 to 10 months exited in a hurry. They didn't just exit crypto, a high-risk asset relatively easy to sell. They also exited equities. Prices fell across the board, and the 60-day correlation between Bitcoin and the leading stock index rocketed up to an all-time high of 0.72. Macro investors weren't the only ones de-risking. Crypto fund managers were also exiting, expecting a general market slump. The spike in correlation was not because Bitcoin was now a macro asset. Bitcoin's entrance to general portfolios has been more or less consolidated the previous year. It was because Bitcoin, along with other risky assets, was being hit by expectations of monetary tightening. Semantics, perhaps, but it matters for the same reason that sunblock manufacturers are in a very different business than ice cream makers, even though their sales could move together at certain times of the year. Then in mid-May came the implosion of the Terra stablecoin ecosystem. This was a crypto-specific crisis, and unsurprisingly, correlations fell as the damage to crypto values far exceeded that in equities. The deleveraging triggered by the collapse of the hedge fund Three Arrows Capital led to further decoupling. With that digested, correlations are on their way back up again, but this is not, contrary to common perception, necessarily because Bitcoin and stocks are joined at the hip. There's an old adage that says, in times of fear, all correlations go to one. We are in times of fear, but Bitcoin and stocks have very, very different value premises, so we cannot assume the correlations will remain high. Bitcoin is a macro asset in that now it is part of a global market, but not all macro assets are highly correlated. As fear subsides, which it will one day, given the distinct value propositions of equities and crypto, we're likely to see correlations head back to lower levels, supporting the narrative of an alternative macro asset. Even before then, as the dust settles on the recent crypto crashes, as the outlook for global equities continues to get worse, and as the risk of holding dollars shifts higher, we could see investors calibrate the relative downsides of asset groups. The resulting flows of funds are likely to change correlations and narratives, driving a new momentum that impacts correlations even further. Which, by the way, I totally agree with, and I think we'll talk about a little bit later how volatility of assets plays into this, and actually how Bitcoin is relatively little volatility compared to bonds, stocks now, and therefore might be getting investors' attention as, hey, this is someplace that has relatively low downside risk and relatively more upside risk. So she finishes up to say, so it's correct to say Bitcoin is macro now and going forward. To say Bitcoin is correlated, however, requires more nuance and explanation, especially to emphasize that the numerical relationship may be convenient for the moment, but it does not mean what many think it does, and it is almost certain to change. So very nice piece there. And then before I talk about Bitcoin volatility, which I kind of mentioned there, I did want to go over one other article that was in the Financial Times that I thought was quite interesting. This was called Volatility Vortex Slams into 24 Trillion U.S. Government Bond Market. Key measure of turbulence in treasuries reaches highest level since 2020 coronavirus crisis. This article was published on September 27th. The $24 trillion U.S. Treasury market has been hit with its most severe bout of turbulence since the coronavirus crisis, underscoring how big swings in international bonds and currencies and jitters over U.S. rate rises have spooked investors. The ICE BofA Move Index, which tracks fixed income market volatility, has reached its highest level since March 2020, a time when deep uncertainty about how the pandemic would affect the world economy set off massive fluctuations in U.S. government bonds. Right now, it is all about market volatility, said Janae Goldberg, a strategist at TD Securities. You have investors staying away because of the volatility, and investors staying away increases volatility. It is a volatility vortex. And they put in a chart that shows volatility peaking at above 250 during the global financial crisis. Coronavirus crisis, it peaked slightly above 150. And of course, that's where volatility is today. So it's very close to those levels. The article goes on to say that fixed income investors' nerves have been frayed by a series of events most commonly seen during market crises. Japan, the world's third biggest economy, last week stepped in to defend the yen after the currency rapidly tumbled to a 24-year low against the dollar. Just days later, plans for big tax cuts by the UK government ignited a historic sell-off in Britain's currency and sovereign debt markets. These international events have added to a powerful pullback in the US Treasury market that accelerated after the Federal Reserve last week delivered its third straight 0.75 percentage point rate hike and signaled significantly tighter monetary policy to come. The 10-year Treasury yield, a key benchmark for global borrowing costs, has surged to more than 4% from 3.2% at the end of August, leaving it set for the biggest monthly rise since 2003. It is on track for the sharpest ever annual rise. The 2-year yield, more sensitive to fluctuations in U.S. monetary policy, has left 3.55 percentage points this year, which would also mark a historic increase. The big price movements have left investors wary of trading in a market that acts as the bedrock of the global financial system and is typically considered a haven during times of stress. With investors on the sidelines, liquidity in the Treasury market, the ease with which traders buy and sell has deteriorated to its worst level since March 2020, according to a Bloomberg index. Poor liquidity tends to exacerbate price swings, worsening volatility. In a sign of how the fraught conditions are keeping some fund managers away, the U.S. has drawn lackluster demand at sales this week for a combined $87 billion in new debt. A 2-year issuance on Monday priced at a high yield of 4.29%, while a 5-year deal one day later priced at 4.23%, both marking the highest borrowing costs for the government since 2007. The 2-year debt was sold with the widest difference or tail between what was expected just before the auction and where it actually priced since the 2020 COVID-induced market ruction, said Tim Simons, a money market economist at U.S. investment bank Jefferies. The Treasury Department will auction off $36 billion in 7-year notes on Wednesday. The 7-year note has struggled to attract demand in less volatile moments, so the environment this week could pose a challenge. Until there's more certainty, I think we will continue to have this buyer's strike, Simon says. The markets are so crazy that it's hard to price any kind of new, longer-dated bonds coming into the market. A divergence between the Fed's own outlook for interest rate and market expectations has added to the sense of uncertainty. According to their latest projections, most Fed officials now expect the federal funds rate to rise from its current target range of 3 to 3.25% to 4.4% by year end. And by the end of 2023, Fed officials expect interest rates to stand at 4.6%. Meanwhile, investors are betting that the Fed will be forced to cut interest rates next year, with expectations in the futures market of a peak of 4.5% in May of 2023, with a fall to 4.4% by the year end. Given persistent and broad-based price pressures, there is significant uncertainty about whether that amount of monetary tightening will be sufficient to bring inflation back down to the Fed's 2% target. Recession risks have also risen markedly, further clouding the outlook. Strong rhetoric adopted by Fed officials about the central bank's battle against inflation has stoked further angst in the market. Many officials now agree that interest rates need to rise to a level that actively constrains the economy and stay there for an extended period. The only other time I've seen us this united was at the beginning of the pandemic, when we knew we had to act boldly to support the economy through the pandemic and through the downturn, said Neil Kashkari, president of the Minneapolis branch of the Fed, in an interview with the Wall Street Journal on Tuesday. We are all united in our job to get inflation back down to 2%, and we are committed to doing what we need to do in order to make that happen. So again, a very interesting article talking, about how interest rates continue to rise, how volatility is peaking, spiking, in really the safest, or what has been historically thought of as the safest market, which is U.S. Treasuries. So, talking about volatility, what's really interesting to me is that Bitcoin's volatility has been declining relative to other assets recently. So you've got U.S. government debt volatility approaching the coronavirus levels, and that's according to the MOVE, or the MOVE index, which measures bond market volatility. When you look at stocks, stock market volatility over the past 12 months is basically doubled. So, it was the VIX, which is the volatility index for the stock market, was around 15 a year ago, and it's around 30 today. So that's a 100% increase in volatility in that time frame. It's been up and down, of course, but it's definitely followed an upward trend as market conditions have pretty steadily deteriorated over the last year. And then when you look at Bitcoin volatility, it's quite interesting. It's kind of fluctuated, and if you go, this would go back a year. It's kind of fluctuated between about a 4 and 2 uh, uh, level of volatility, and then it kind of spiked in July to about 5.5%. Sorry, 4% and 2%, 5.5%, and then it's just kind of collapsed, and it's really been at like zero uh, for since basically for the last 2 months, and I think that's because again the price movement has really leveled off. So in other words, it was um, a year ago, Bitcoin price was 60,000. Uh, Today it's around 19,000, but it's really been fluctuating in that 19,000 to, 20-ish thousand range, all the way back to July, pretty much. And so we saw a big increase in volatility as the price collapsed, and then when it hit 19, the volatility is just basically gone, which I think is just quite fascinating. Uh, Typically, Bitcoin has been significantly more volatile than all the other assets, and especially bonds. I mean, historically, bonds have really been the least volatile. They have, typically very small movements, and certainly in times of, if you go back to 2008 financial crisis, that was the bet. You put your money in bonds, interest rates fall, bond prices go up, but it's all very orderly and very small movements from day to day. Um, I don't think that's the environment that we're in today, given the incredibly larger amount of debt that's outstanding compared to back then. And if you remember back then, the central banks had to bail out the banks. So now the central banks have all the debt, and who's going to bail out the central banks? They they have to bail themselves out, and that means you have to look at Japan for an example, but that means either bond crisis or currency crisis, and it's just something we haven't ever seen before in developed nations. You see it all the time in developing countries where they have bond crisis, currency crisis, hyperinflation, but you really haven't seen that in developed nations yet. But again, our over leveraged debt based system is struggling with inflation and higher interest rates. My own opinion is that this quantitative tightening and raising of rates that the Fed has been engaged in, and that other central banks are also following suit, uh, can't go on for too much longer, at the risk of the system completely imploding. And I don't think they're going to let that happen. On the flip side of that, going back to QE and rate cuts will only fuel inflation, but that does seem like the likely path. And if history's any guide, that's where they'll go. And we've already seen, obviously Japan hasn't relinquished their yield curve control. Uh, Bank of England is already pivoting. Um, the Eurozone hasn't really stopped QE, even though they've been raising rates. They really haven't stopped quantitative easing because they're buying bonds in some of the weaker countries and selling bonds from the wealthier countries. So it seems like that's the path that we're headed down. The central banks really don't have any good choices at this point. If they don't print money, they'll collapse the system. If they print money, then they'll inflate, and that's a small amount of inflation they don't mind, but too much inflation, causes obviously civil unrest, and um, it's unsustainable, and it can quickly get out of hand once people start believing that inflation is going to be a um, a problem. They'll change their behaviors. They'll start hoarding things and buying stuff in larger quantities because they're afraid prices are going to go up. They'll accelerate purchases that they would otherwise wait because they're afraid of prices going up and that sort of thing. A really good book is called When Money Dies by Adam Ferguson that I read a couple of years ago. That it's written by a historian, but it tells you about what happened in Weimar Germany just before World War II, and how their currency collapsed. And I think it's quite instructive, and it's almost a little chilling how some of the things that happened in there you're kind of starting to see happen around us today. For example, rise of labor unions because uh, people need their pay to be keep up with inflation, and laws are passed that are intended to help, and they don't, like the um, like the latest federal legislation that came out, the Inflation Reduction Act, which they say look at the name and then assume that it does the opposite. So bottom line is the fiat system is broken, and uh, and so Bitcoin, I think, lets you opt out with the hardest money known to man, and having some allocation of Bitcoin, I think, is generally believed to be a good hedge. It's money that's outside of the system, and so nobody can take it away from you. It's safe in that respect from government intervention, and it will probably, especially given how bad markets have been and how relatively not non-volatile Bitcoin has been. It seems to be uh, finding a market for people that want something that's going to um, again be outside of the system, so that if the system were to really suffer a reset, um, you wouldn't really be too worried about about that part of your portfolio. And indeed, if things got really bad, Bitcoin should perform, you know, a lot better than other assets. But I'd expect it to perform, similar to gold or silver in that type of an environment. Again, reminder about the qualities of Bitcoin. It is absolutely scarce. There's only 21 million coins that will ever be in existence. You can transfer it peer to peer without an intermediary, so you don't need a bank or a finance company to give you permission to send the money to someone else. You can just send it to anyone, anywhere in the world with a computer and an internet connection. Bitcoin network operates independently of all legacy financial systems, so it is the first digital global payments infrastructure. There's no counterparty risk when you self-custody it. Um, it's on you to protect your keys, be responsible. It's trustless, so Bitcoin is not controlled by any person or group. And again, I feel like it's a hedge against fiat currency debasement and collapse in much the same ways that gold is, except it doesn't have gold's drawbacks of difficulty to validate, store, transfer, and secure, especially in large amounts. What I'm also learning too is that the Bitcoin Lightning Network, which is a layer 2 protocol that's being built on top of the Bitcoin network that allows for anonymous and fast payments, which are then sort of aggregated and then settled on the Bitcoin network in chunks. Uh, it allows you to do small payments for virtually no cost. and just scan a QR code, and you can send Bitcoin from your Lightning wallet to another person, and there's a lot of development going on in that particular area that's very exciting, and I think is potentially disruptive to the traditional, like the credit card companies and that sort of thing, because again the costs are very low and you get final settlement, which a lot of times credit card transactions take, or even ACH transactions take a couple days to settle, where these can settle every 10 minutes or whatever. So very excited about that. And I think there's a lot of potential for Bitcoin Lightning development in the future. So that's about it. Thanks for listening to the podcast. If you enjoyed the show, please like and leave a comment. Also, don't forget to subscribe on your favorite podcast app so you don't miss an episode. You can also follow my Substack at bitcoinfortress.substack.com. And you can follow me on Twitter. My handle is @Nick Reichert. And I will talk to you all next week. Bye bye.